Good afternoon and welcome to the webinar series by the Institute of International Monetary Research in collaboration with the Vincent Centre for Public Understanding of Economics and Entrepreneurship at the University of Buckingham. I'm Ewen Stewart, I'm the Director of the IIMR, and today we're extremely honoured to be hosting Gerard Lyons. Welcome. Gerard is known to very many of you. He's an economist by trade. He's got a very long track record in the city and also in public policy. He currently has a number of roles. He has three main city roles, actually, and a number of other roles. He's the chief economist at NetWealth, the discretionary wealth manager. He's on the board and is the senior independent director of the Bank of China in the UK. And he's also on the board and chair of the risk committee of BGC Partners, the interdealer brokers, which is part of the Cantor Fitzgerald Group. As well as that, Gerard has a number of other roles, but just a couple of others worth mentioning. He's a research fellow at the Centre of Policy Studies in Tufton Street in London. And last year, he was reappointed to the UK Economy Honours Committee. You can find out a lot of information about him. You can Google him. You can see many articles he's written. But also his website is very interesting, www.drgerardlyons.com. Be worth having a look at that. But we're really honoured you've given us your time today, Gerard, and thank you for that. A nice, easy opening start. Andrew Bailey's doing a great job. Is that right?
Well, first, Ewan, it's great to be on. Thank you for inviting me to speak to you and to the audience. Yeah, the opening question, a bit like an English batsman facing the Australian fast bowlers, actually. I'm going to play it with a straight bat, I'm afraid. Look, obviously the governor's role is vitally important. The tone from the top is vital in any organisation. But when it comes to the bank, I think we need to differentiate between personalities versus processes and policies. So let me comment on the process and then on policy, and that will lead into maybe a wider debate linked to your question. In terms of process, look, there's no doubt, as the Bernanke report from the year before last now highlighted, there are huge institutional failings at the bank. The Bernanke report talked about governance, judgment and strategy. But above all, what we've seen really since the 2008 period is that monetary policy has not necessarily been pointed in the right direction. And the bank has failed in its core job of keeping inflation under control. Now, that predates the present governor. This has been a legacy issue. In terms of that process, when we moved to cheap money, we very much, I would say, we've been through the good, the unnecessary and the bad. The good immediately after the global financial crisis, when it was correct that monetary policy was eased and that quantitative easing took place. Then we went through that broad, unnecessary period under Governor Carney when monetary policy was far too loose. And then we've had the bad in recent years, particularly in terms of the reaction to the pandemic. But leading on to the sort of policy itself, maybe if we bring up to current times, I think the governor at the last two meetings has played it correctly. In fact, I would have agreed with him in both of those meetings. In terms of the 9-person MPC, we now have very deeply divided camps, 4 doves and 4 hawks. And the governor has had the casting vote at the last two meetings and decided to ease at the last one, which was correct. What I would like to see, but rather than sort of giving you such a long answer to this question, what I think the last few meetings have highlighted is that monetary policy has been far too reactive at the bank. It's been far too backward looking. Back in the day, it used to be said that monetary policy operated with a long and variable lag, 18 to 24 months. We often seem to have monetary policy set based on the latest economic indicators. But I would argue that there is now a clear case for monetary policy to be eased. So in terms of the governor, you could say overall, it's better to look at the process and at the policy, but the bank really needs to achieve its core objective of getting down to the inflation target and then subject to that supporting the government's economic policy. Thankfully, this year, I do think maybe as early as April that the inflation target of 2% will be met.
I have a lot of sympathy with what you've said there. I think I would agree with you that QE did its job in 2008-9. And I'm also inclined to agree that the Carney years were initially described as a great moderation, but in I feel policy was too loose. And then obviously in the second round of QE over lockdown, we saw a huge expansion in the money supply, which led to quite an inflationary bubble. But what I think we've seen is a change in philosophy. If we went back 25, 30 years ago, I think the Bank of England would have spotted the growth in money supply and acted accordingly. This time, they don't seem to monitor it very closely. Yeah. Why do you think they've so disengaged from monetary policy philosophically? And even to this day, they seem to deny the link, blaming inflation more on the situation in Ukraine or energy shocks or the effect of lockdown on the supply chain. Do you agree with that analysis, or do you think?
Yeah, well, there was a whole host of issues in there, but in terms of, let's take the money supply issue. In fact, it must be about a decade ago now. I wrote an article for the Telegraph and said what word is missing from the quarterly. I think it was then called the Monetary Policy Report, or it might have been the Inflation Report. But which word is missing from that quarterly report? And it was the M word, money. I just had read the latest version and I finished reading it. I thought, this is odd. Then I checked and then I thought, they've not mentioned money. Then I went back to the previous one. They hadn't mentioned money at all. So this is a long running issue. Now, given that the target is to achieve inflation, you should actually, in my argument, whether you're a monetarist or not, certainly if you're a monetarist, you're going to be looking at this data and be all over it. But so even if you are not a monetarist, your dashboard should have money supply, bank lending, credit growth, and that should be really sort of sending signals to you. It's like all those, I'm not an expert in terms of cars, but if I'm driving the car and something flashes up, I tend to go and get it checked straight away. And if you had money supply up there on your dashboard and it started to flash red, as indeed it did in the States, say, for example, a few years ago, you would immediately be thinking, well, let's interrogate that and find out what's going on. But your wider question, there are two different ways of approaching this. One is in terms of the post-1971 Nixon shock and the argument about how inflation has taken hold at different stages since. And that's very linked to the current debate about stable coins and crypto and other issues. And that's probably a tangential one to the one you're asking. But also the other issue is very much that we've been very much driven by Keynesian analysis. I think Keynes is great. I don't think Keynes would be advocating many of the things that people attach to him. But fiscal fine-tuning is important. But that does not mean that you use output gaps as your sole guide to whether there are inflation pressures or not in the economy. Anyone who has looked at output gaps in detail knows that with hindsight, they're always proved to have been wrong. That is, what we thought was the output gap now, the spare capacity, is not actually what it really is. And we only tend to find that out with a long and variable lag. So we're very much driven by seeing fiscal policy as the lever to pull. Monetary policy certainly became the shock absorber in the last 14, 15 years. But in terms of output, when I say in terms of driving inflation policy, it's often been looking at output gaps and how the economy has done relative to that. I think that clearly, coming back to your question, has not proved to be the very best approach.
Yeah, I think we're in agreement. I am very surprised that output gaps are such a large part, particularly in a globalized world, in a really controlled national economy where there was a little trade, maybe, but even there, very difficult to measure. But there's been a revolution in thinking, really, where that seems to have been really the primary focus. We had a conference at Buckingham with some MPC members 2 or 3 months ago, and I think there was some recognition from the Bank of England. I don't know if you've picked that up, that they may not be monetarists, but at least they should have it on their dashboard, to use your car analogy. Have you picked up a similar change in tune from your conversations?
Well, the answer is yes, but maybe if I could answer that in a wider way, you need to look at the output, the result, and what's happening. And there is absolutely no doubt that in recent years, UK gilt yields, for instance, now have a risk premium attached to them. Now, that's high yields relative to other comparable countries. One aspect of that is questions about fiscal policy, but another aspect of that has been the stickiness of UK inflation. Now, many factors contribute to UK inflation, but the day Russia invaded Ukraine, the inflation target was already been exceeded by more than threefold. And if you look at the RPI measure, it was even higher than that. Now, the long decade of cheap money led to lots of problems. And these should have raised questions about the approach. We had asset price inflation. We had a misallocation of resources in terms of zombie firms remaining, growth companies not having access to capital. We had markets not pricing properly for risk. And then we had the pickup in inflation. Now, when you have that sort of output as a result of monetary policy, it should immediately lead you to start questioning the approach that's been taken. And I think that has, maybe coming back to your question, started to filter in. There are wider issues as well that we can come on to, because it's not just about monetary policy and inflation. Financial stability has been a big issue. Your opening question about the governor, I saw that he and I were both attending the same event a couple of weeks ago, without giving any secrets away. But a question I was raising at that event was about what we're seeing in terms of financial stability now and the wider role of shadow banks. And the governor plays two roles. He's not only the governor of the Bank of England, he also chairs the Financial Stability Board. And under his watch, they've done some good work in terms of shadow banks. And I noticed that in the last week in testimony to Treasury Select Committee, the governor has talked about the potential risk here. Now, at the moment, it's not a real risk, it's a perceived risk, but it's a perceived risk we need to take seriously. And briefly, it's this, that as the Financial Stability Board showed at the end of last year, shadow banks now have more assets than banks globally. Their rate of growth of their assets exceeds the rate of growth of banks. Now, within shadow banks, there's an incredible umbrella. One side, we've got pension funds, insurance companies. And then at the other end, we've got the highly leveraged, very opaque hedge funds. Now, in terms of the big worry is that government bond issuance is very high, unlikely to be dropping anytime soon. And what we're seeing is a big change in the whole disintermediation process. We're starting to see not just the shadow banks play a bigger role, as I've said, but in terms of the holding of government bonds, the shadow banks now start to own significant amounts. Now, the insurance companies, pension funds, that's more cross-border. You might initially say there's no harm in them holding more government bonds overseas. That's part of their portfolio investment. But they tend to hedge that with derivatives, which tend to have maturity of less than 1 year, particularly FX swaps. So there's that big rollover risk. 3/4 of that hedging is less than 1 year maturity. Then you go to the other extreme in terms of the hedge funds. What we're seeing is use of repos, gilts, or as collateral, and there's no haircuts being applied. Leverage is very high, and basically the way they trade leads to very large positions. What this means is that there's a lot more risk involved in the whole gilt markets and government bond markets than previously. And it feeds into a wider issue linked to the global picture about what constitutes a risk-free asset. So when one looks at the bank, first and foremost, coming back, they need to do their core job, which is to get inflation under control. And I think inflation will fall significantly in the UK this year. And second, financial stability risks, which were always there, I think are now even more important as we move through the next stage of this cycle, particularly in 12, 18 months, maybe, when monetary policy easing globally has come to its end.
Yeah. Now, there's a very interesting comment actually just come through from one of the listeners. We'll keep the listeners' names anonymous, but he says, Gerald, you make a very valid point about banking being reactive to events and not proactive. He says the big problem here is the MPC has that they are deeply data dependent, but it's like driving a car and looking continuously in the rear view mirror and not seeing what's coming up ahead of you. And
I agree.
Yeah, it's a genuine problem. I mean, the ONS is extremely rich with data, but it's open to quite substantial revisions and often out of date. But so I think that's I'm not sure how we get around that problem.
One of the issues in the market is what is the end game? What's the terminal condition for interest rates? Now, if we go back to Jackson Hole before the pandemic hit, then the perception was that R-star neutral rates after allowing for inflation were close to zero in America, Britain, Germany, and Japan, I think, at that meeting. So if inflation was 2%, R-star zero would mean that bank rates should be 2%. So R-star is wherever it should be above your inflation target. So no one's quite sure where neutral rates is. And I think that feeds in, while your listeners or viewers' question was linked to slightly different, I think that also adds to the issue. What's the actual direction of travel? It's about getting inflation down. It's about ensuring that inflation expectations are grounded, and then seeing interest rates move back to that sort of neutral level. This year, actually, it's not just domestic factors one needs to be taken on board, it's global factors. I think involution is the buzzword, or it's my buzzword anyway. It might become the buzzword this year. Here in the UK, we've got sticky service sector inflation. We had that in the 90s, actually, interesting enough, before we eventually moved down to much lower inflation overall. So sticky service inflation for a moment. Goods price inflation starting, in my mind, to ease. But the key factor that will drive it even lower will be intense global competition. We have a very imbalanced global economy, and that's highlighted by China's huge current account surplus. I go out to China frequently. I often think it's a case of appreciating how competitive the Chinese industrial base is. And we're seeing trade diversion now as a legacy or consequence of tariffs. And a lot of high value, relatively cheap Chinese goods, particularly as the Chinese currency is effectively shadowing the dollar, and the dollar is weakening, and the dollar could weaken, and it probably will weaken further this year. So you add all that together, intense competition in China, and that's the buzzword involution that they've used for the last 18 months or so, a relatively cheap currency, then that trade diversion. And we're likely to see a huge influx of cheap goods into Britain and across Western Europe. Add in the fact also administrative prices, including energy prices, in April will fall. I think we could get down to 2% inflation as early as April. The question then is where we actually see inflation settle and what that means for interest rates in the UK. I don't think we should be racing back down to very low rates. I see interest rates going down to 3.5% by spring and maybe towards 3% by the end of this year. But I personally think that interest rates in terms of neutral rates, nominal terms, should be around 3.5%. I think we'll go below that neutral this year and then probably back up in a couple of years' time. But point is that many factors, one needs to be forward-looking, not only about having a grounding in theory, monetary data, and that dashboard, looking at forward-looking indicators in Britain and the forward indicators globally as well.
Now, the Bank of England has a single mandate to try and keep inflation at 2% or less, unlike the US, which has got a more balanced mandate. Do you think, you wrote a very interesting piece in the Telegraph 2 or 3 weeks ago, simply titled 1236, with your prediction of 1% growth, 2% inflation, 3% interest rates, and 6% unemployment. The UK's had a growth problem really since the global financial crisis, and per capita terms, our growth has stagnated. This government, I would argue, has done an awful lot to harm the prospects for domestic growth. But do you think they are likely to put pressure on the Bank of England to lower rates below where naturally they may wish them to be? Or do you think that the bank will withstand that if growth continues to disappoint? And I'm marginally unconvinced by the link between interest rates and growth, but regardless of my views, the central bank appears not to be. I don't know what your thoughts on that are.
Well, if I could answer it in a slightly different way, I think where the bank may have left itself open is in terms of future QE. And this is where the government could put pressure on the bank. I don't think the pressure directly will be on interest rates. Obviously, there's other issues here about appointment process and the fact that the Treasury controls the appointment process linked to the governor, all the deputy governors, and every member of every policy committee. But that's slightly tangential. And one could argue that Westminster hasn't really held the bank to account. I'm not just talking about the current people at the bank, but going back a long period of time. And I think that is an issue. It was the Forsyth Committee in the House of Lords that first really raised questions a few years ago. So these are wider contextual issues. But in terms of your question, I don't think there will be direct pressure linked to interest rates. But in early December or late November, maybe, the governor wrote a letter to the chancellor, 4-page letter. I was surprised it got mentioned in the media, but it didn't. I was surprised it didn't get wider scrutiny. In it, the governor basically said that QE was an overwhelming success. And we've already touched on that it's not. And one can take a certain time period and argue that it worked, but over the broad brush period, I would argue differently. Now, this is where the governor and the bank might have left themselves open. If towards the end of this year we have a fiscal position that deteriorates again, it might not deteriorate as much as people feared this year, just because of that nominal GDP growth we're seeing and the fact that the buffer built in at the budget last year gives a bit more room for the manoeuvre to the Chancellor. But nonetheless, there's a risk, and it's not an insignificant risk, that the fiscal position will be poor and deteriorating. And that would mean the Chancellor needs to raise more funds. Taxation is trending higher. But in terms of this particular year, it might be a route to say, Governor or the bank, you told us QE's phenomenal, great, brilliant, or whatever words were used. Could you do some more of that for us later this year? That's where the door could be pushed open, not in terms of interest rates.
Would they dare, do you think? I mean, the previous rounds of QE from both the global financial crisis and lockdown occurred in tandem globally, with the US Fed, the ECB, Bank of England, Bank of Japan, all QEing at the same time. Do you think it would be credible for a medium-sized economy like the UK to QE in any meaningful way if the ECB and the Fed were not doing so?
Well, they all have different approaches to their exit strategies. And the exit strategies are claimed to be technical in nature, but they clearly have a wider impact not only on the shapes of the curves, but indirectly, therefore, on the economy. So in answer to your question, yeah, domestic factors can drive policy, not just on rates, but also, as we've currently seen, in terms of QT, and therefore, by implication, QE, QT being quantitative tightening. But it leads into the why. Look, the bank this year will probably do the good job in terms of achieving the inflation target. The governor seems to be very on the ball about the shadow banking problem. Partly, I say that partly because I've been talking about it extensively, and I don't think people have really cottoned onto it. And he seems to be very much on the front foot on that. I disagree with the approach the bank has taken on QE, on QT. But what we need to see is clear messaging domestically and internationally. And maybe the best guide will be the extent to which that premium on UK debt starts to come down. Admittedly, it has actually been reduced in recent weeks as the market becomes more confident about the inflation prospects, notwithstanding what happened at the last month's meeting, and about the fact that there is still scope based on domestic factors for policy rates to fall further in the UK.
Yeah, no, I mean, the UK premium, particularly at the long end of the curve, is quite high, actually, relative to bonds and even other European.
Yeah, it's linked to those two factors I touched on about sticky inflation and fiscal policy. You could also argue legitimately, as the OBR, Office of Budget Responsibility, pointed out in their risk assessment last September, that when one looks at defined benefit pension schemes, which have been a very big buyer of the longer end, they will be buying a significant smaller proportion as we move ahead. There are some other issues linked to the bank, I think, that are important at the moment. I think the bank should not be paying bank rates on full reserves to commercial banks. Now, some people argue that that would be a tax on the banks if they didn't. But you talked about QT and QE referencing the Fed and the ECB. But the bankers argued that not paying bank rate on reserves would not allow monetary policy to operate properly and would impact financial stability. I disagree on both, actually. You can actually adopt a tiered system, as the European Central Bank has done, so you reduce the fiscal cost and you still allow monetary policy control to operate, and you don't have any excessive overnight volatility in interest rates if you still have a tiered system. And financial stability risks would not be increased. Gilts naturally count as high quality liquid assets, but there are assets that do count. And currently paying bank rates on those reserves effectively incentivizes many of the commercial banks to hold more reserves than they need to. So there are certain technical things that can be done in terms of addressing the whole plethora of monetary and financial issues at the moment. But maybe coming back to a point you've touched on, what I think is the issue in the UK linked to the growth picture is that we need to have a clear growth strategy. Unfortunately, I think we've had 25, someone's told me 25 growth strategies in the last 15 years in the UK. They haven't worked very well, have they? But we need to have almost three core parts, and it's not micromanaging the economy. What one needs is clear fiscal credibility, and that means reducing debt to GDP and getting public spending under control. Second, not necessarily in order of importance, but second, supply side agenda about improving competitiveness, incentivizing business, and actually getting all the I's right, I always argue, in terms of investment, innovation, infrastructure spending, and incentives through tax and regulation. But the third area is the one that's always overlooked, which is about monetary and financial stability. And I think that's as equally important as the other two. And naturally, given the scale of debt to GDP, monetary and fiscal policy become very interlinked now.
I think that's right. I mean, the UK's growth record, as you're well aware, over the last 15 or 20 years has been extremely weak. And that has stressed tax receipts to an extent. I mean, there's nothing you've said I can disagree with, but the problem is we are running a fiscal deficit of about 150 billion. Debt to GDP is about 95% of GDP. The current government are unlikely to want to cut spending, and spending continue to grow in excess of CPI. So in the short to medium term, and they've also increased regulation. The supply side has generally moved in a disadvantageous way for business. So I'm struggling to see what will kickstart domestic growth in that environment. And it becomes a bit of a doom loop because if the economy isn't growing, it stresses the fiscal deficit to a large extent and makes it very difficult to cut taxes and start to stimulate the economy. So it seems the philosophy, the desire to do what we would probably argue isn't there. And I wonder if we're not really in a situation for the next, until there's a change of philosophy, 2 or 3 years of very, very low growth indeed. And difficult. I find it difficult to see how we get out of that without a policy change. I don't know if you'd agree or not.
Well, I think opinions are moving on this. In terms of growth, right, even though the situation is difficult, this year, you mentioned, thanks for mentioning that piece in the Telegraph. Yeah, the growth figure I had for this year, I said it was 1.4%, but we have a very differential picture. Unemployment, unfortunately, which is 5.1% at the moment, had been 4.1% at the time of the general election. That's the one figure that's going to go up to 6%. So you've got unemployment high, higher taxes do not incentivize firms in the hospitality, retail sector, higher minimum wage, whilst it's beneficial for those that receive it. The net effect is that youth unemployment rises as well. So there's a negative there. But you still have people are seeing real income gains, Even though private sector pay lags public sector pay, it's likely to be in excess of inflation this year. So the economy is growing at a steady pace. Now, it's about really confronting the issue. Now, I wrote a big paper for Centre for Policy Studies at the end of last year, Breaking the Cycle. But remembering it, but I thought, let's take the fiscal issue. If you won the next election, whoever you are, in 2029, and you wanted to address the issue of the fiscal side, then the nominal rate of GDP growth that the OBR is assuming as we end this decade going to next, the 3.7%. Now, if you assume that continued during the next parliament, which is a non-contentious issue, I would say, if you wanted to reduce public spending from 45% to GDP to 40% of GDP, is currently very high. 45% could be slightly higher, but a 5% reduction, that sounds really daunting. But against the background of nominal GDP growth, effectively what it turns out is still allows you a nominal increase in public spending of 1.8% per year over the whole lifetime of that parliament. And assuming a 2% inflation target, it's a real 0.2% per annum cut in public spending. Now, we can all argue about the different figures, whether it should be 3.7% nominal GDP growth, etc. But the point is this, that you do have the ability, once you have a concerted effort, to make some inroads without going back to what would be termed widespread austerity. The challenge for public spending is that we almost have three parts. We have the ring-fenced area, health primarily, second, the non-ring-fenced, and third, the cyclical areas. And it's the non-ring-fenced parts of public spending that are really squeezed. Now, to genuinely make an inroad into public spending is about controlling the pace of health spending growth. And that was the challenge that comes out of the latest comprehensive spending review. Health spending still is the dominant increase, but 2% per annum compared to the average of 3.4% per annum over the last 15 years. And also, it's about the key one, welfare spending being brought under control. In answer to your question, I don't think that issue is going to be addressed in this parliament, but it could easily be addressed at the time of the next election. Figures are going to be daunting, but one can have a credible approach that is not draconian. The question is whether it's immediacy versus gradualism. The markets, if they see the situation continuing to deteriorate, will demand immediate action. Politically, it's a case of gradual response. I've tended to argue that when you look at the picture, you've got 6 options when it comes to debt: grow, reform, tax, austerity, borrow, or inflate the debt away. Inflate the debt away is not desirable, whether it's through financial repression or another round of QE. Ideally, you want growth. But the interesting point is that if the economy had grown in the last 15 years at the rate it had grown ahead of the global financial crisis, it would not have prevented debt to GDP from rising significantly. It would have risen, but it probably would have peaked about 20, well, it would be now about 20 points less. It'd be less than 80%, but it would still have risen significantly. So growth is the ideal option, but you need to have monetary and supply side policies, but it's not the only thing. Reform using AI and technology, that can't be done overnight. And you do need to have a productive public sector. It plays a key role. So it comes down to curbing public spending, which we've touched on. And then it also comes down to your ability to use borrowing as a lever. Obviously, tax is already very high. Some people would argue it's the tax route we should be taking. I would disagree. Some argue that quantitative easing shows that we can borrow even more through the Bank of England. I would not go down that route. So it comes back to having the policies in place to incentivize growth, the policies in place to follow through and reform, and the policies in place to curb public spending without sort of causing an overnight deep problem for the economy, and that's not easily done.
Yeah, I think your six routes, I think it's a very neat way of looking at it. And I agree with you that the UK has lost its tax competitiveness relative to Europe. And I think we're probably approaching a point that further tax rises could be counterproductive. And we've touched on debt levels, which I completely agree with you on QE, etc. So that does leave the growth route. And I suspect in time the UK will be forced to adopt that, but hopefully sooner rather than later. Is it worth moving to the global picture and what's happening in other jurisdictions? I mean, you touched on the need for higher defense spending, which certainly European countries have all been making promises. Whether they're real or imagined, time will tell. But I think we can absolutely agree this is an unprecedented geopolitical backdrop. Where do you think, looking at the major jurisdictions, we're heading at a macroeconomic level, and you know, what are your main takeaways?
Okay, well, geopolitically, we're seeing a G3 world, US and its allies, China and its allies, and the third group is the middle ground powers who are becoming more important globally, whether that's Brazil, Nigeria, India, Indonesia. But that leads into the economics as well. What one is seeing is that Western Europe is the slow growth region of the global economy. The Indo-Pacific has become the fast growing region, and that stretches from India in the west to America and the Pacific Rim. So in terms of geographic terms, that's where the growth is. Now, it leads on to sort of the big growth engines, not just in terms of countries, but are there sectors? AI grabs all the attention. Now, we're seeing a vast amount of capital investment in AI. It's not clear that, well, it's certain not all of that is going to be commercially viable, but we hope that some of it will be. But the positive for the UK in some respects is that when one looks at the global AI comparison, America and China, while they're number two, Britain is sort of heading up the next pack in third place. But it's probably, if I use a football analogy, we use cricket at the beginning, but it's almost like going from the Premier League through the Championship down to League One. That's almost how far it seems to me that the next pack is versus America and China. So Britain is in an important place there. So coming back to your question, the global economy, according to the International Monetary Fund, and there are many different forecasters, but let's just use them as a benchmark. They are talking about global growth last year and this year being pretty similar, now 3.1, 3.2%. Now, that shows some degree of resilience in recent years. But if we compare it to where things were before 2008, the global financial crisis, then global growth was 4.5%. So the world economy is growing at a much slower pace. And the bulk of that growth is away from Western Europe. And it really comes back to the challenge for Western Europe is about remaining competitive and increasing its competitiveness, not just in terms of price, but in terms of quality. And we have that involution threat, if we can call it that, that will very much hit the manufacturing sector. The UK, with its service sector and with its AI position, has some positives. But we need to be making sure that our domestic policy in terms of energy and that tax is competitive. I'm very much of the view that we need to take the green agenda seriously, but I've always argued for energy addition, not energy substitution in terms of our approach. And in terms of tax, I clearly would be arguing for not going down the route that we're going down at the moment. But it's more than tax. That's the important thing. And that's clear from the earlier discussion.
Yeah, no, I agree. I mean, I'm just interested in your thoughts on Trumpnomics and the big beautiful bill, and whether you think tariffs are a structural part of what he's doing, or whether you think they are designed for negotiation. In the Institute, we're a bit concerned about the inflationary, in fact, more than a bit concerned about the inflationary outlook in the States. The money supply numbers have not been great in the States, not certainly consistent with rising inflation. Trump is certainly putting pressure on the Fed to lower rates, whether they do or not time will tell. But America is still the most powerful economy in the world on many measures. What your thoughts are there, and what the impact is likely to be for Europe and perhaps the UK?
Yes. The way I described it at the beginning of last year is still the way I would describe President Trump's policies in terms of the good, the bad, and the uncertain. I know it's a sort of old sort of film, shall we say. The good is his pro-business policies, that big, beautiful bill, but it's more the general pro-business environment. And that has galvanized big parts of US business, and that's a positive. The bad is the tariffs, no doubt about that. And I'll come back to that in a moment, linked to your question on inflation. And the uncertain is linked to the budget deficit. I think the budget deficit is a worry, but because of the reserve currency status of the dollar, America has been allowed to enjoy that exorbitant privilege. There's some interesting research actually out at the end of last year comparing the States now with Holland and Britain back in the 16th, 17th century, Holland and Britain, the 18th, 19th century, when both of those countries enjoyed an exorbitant privilege, but how fiscal policy was a key factor leading to it being lost. When you have the exorbitant privilege, you can fund a much bigger budget deficit. Yeah. When people start to lose confidence in your currency, then you need to start bringing it back into line and running primary surpluses eventually. And last year, the way I described it is that we saw passive diversification away from the dollar. People were not actively selling their US assets. They were putting less of the net new money into the States, or indeed in some cases hedging more of their dollar exposure. I think we're now seeing more active selling of the dollar. That's also linked into the rise in the gold price, which reflects geopolitical tensions as well as other issues. And it raises, again, the question as to what constitutes a risk-free asset, which raises concerns about government bond markets more generally, particularly the role of shadow banking in them. But in terms of the tariffs and inflation, the Fed minutes at the end of last year I thought were quite good. They talked about core goods price inflation being stickier because of tariffs, and that they talked about tariffs keeping inflation higher this year, 2026, and next year, 2027, before coming back down in terms of the inflation impact in 2028. So their view, the difference at the Fed meeting at the end of last year from the minutes was that they now, more members of the Fed felt that tariffs would not have a permanent impact on inflation, but it would be more sort of persistent this year and next, and then fall away thereafter. So there are problems. There is that persistence of tariffs and how it inflects inflationary expectations. I would say the other issue in the States, though, is at the moment is that there is more evidence of input costs not linked to tariffs rising. And that's what you need to keep a close eye on in the States, whether there will be more stickiness in the inflation cycle, and it's not only a tariff effect, it's elsewhere.
Yeah, I mean, I think your point about the privilege the US has in terms of global reserve currency is an important one, and they are, to my mind, testing it to quite a limit. Their debt to GDP is up to 120% odd. They're running a 6% deficit. They're going to spend a lot more if you believe Trump on defense. So it strikes me that there's a risk of monetization of that debt at some point, because the debt interest payments of topping $1 trillion a year, very similar to defense expenditure, and it strikes me that they're close to maxing out on what is credible.
Yes, I believe that 6 of the 7 G7 countries face a debt trap by the end of this decade. Ever rising cycle of debt, which poses problems, particularly as debt interest payments will be high. Germany is the exception, but Germany's fiscal position is going to deteriorate significantly. Germany lost three key props in the last few years: cheap energy from Russia, free riding on NATO, and selling cheap manufactured goods into China. Its industrial base will be given a temporary reprieve from embracing higher fiscal spending linked to defence. So even though they're the exception in terms of the G7, their fiscal position too would deteriorate. The problem bringing it back home for Britain and for France is that these two countries are more dependent on international investors to buy their debt than the others. Japan had a wobble a couple of months ago, even though Japan has had high debt for some times in terms of debt to GDP, is being dependent on domestic buyers. But even there, they ran into difficulties, the States too. But for the UK, it's very important for the UK to have not only a credible narrative that keeps the domestic electorate on side, but I would argue, very importantly, keeps the financial markets on side and keeps the bond markets on side. And at the same time, in addition to that narrative, it's not just what you say, it's what you do. Yeah. And what you do needs to be monetary policy that keeps inflation under control and achieves financial stability, fiscal policy that caps that rise in debt to GDP as much as one can and starts eventually to control public spending, and a supply side agenda that makes the economy far more competitive than it currently is. It's a tall order, but the confidence I would have is that more of these issues are now being discussed, and one needs to bring the electorate, the country, with you in terms of winning the argument on this.
Well, Gerard, I have to say, what a tour de force, what a wonderful conversation, and thank you for being so open and frank with us and covering so much ground from UK monetary, fiscal, Trumpnomics, China, and much more. It's been a really fascinating discussion, and thank you for tuning in, everybody. On behalf of the Institute of International Monetary Research at the University of Buckingham at the Vincent Centre, thank you very much indeed. Thank you, Gerard, and we'll hopefully see you next time.